Hey, how's it going? When it comes to buying a house in this market, it really takes about 8 steps before you actually get the keys and move in. So today we're going to talk about the first step, and that's getting pre-approved and answering exactly what it takes to get pre-approved and what loan officers are looking for when they pre-approve you. Let's get straight into the video. Hey, how's it going? My name is Akeem Highland. They call me the quarterback agent. I'm here to tell you exactly what it takes to get pre-approved in this market and how you can make sure that your pre-approval is ironclad, like really strong, crisp, clad, clamped, like all a bunch of other C words that I can think of, that it is going to make sure that when you find that house, there's going to be no problems with going from your offer to the closing table. All right, so first thing we should talk about is exactly how to distinguish whether you're pre-qualified or pre-approved, okay? Because they're two different things. Someone can pre-qualify you. Generally speaking, it means that they just went based on the information that you gave them, probably on the phone or in person. They didn't exactly run your credit. They kind of just said, okay, well, if you make 80 a year and your credit is about this, typically you can get qualified for this amount. You know, that's really what a pre-qualification is. There's no real work done behind it. But with a pre-approval, once you get pre-approved, we run your credit. We look exactly at your income. We tell you which income qualifies, because not all income qualifies with certain situations. Like if you're self-employed, but you're only been self-employed for 1 year. There are certain products that we can use for that. But typically speaking, not every bank accepts that. So we want to make sure that you're pre-approved. You have your credit ran. We're going to look at what's called your debt to income ratio. Basically, what we're going to do is see how much debt shows up on your credit, and then get to how much of a percentage of that debt is factored in against your income. For example, if you have income of $5,000 a month and your debt is probably $2,500 a month, then we know that you have a 50% debt to income ratio. So based on your income, the amount of debt is 50% of how much income you're bringing in every month. Okay, so that's very important, but it isn't just the only thing that we consider. We also consider your credit score, and more importantly, the body of your credit. What's on your credit report, all right? Do you have any foreclosures? Because you can have a great score and still have a foreclosure on your credit, and those things are important. So, do you have any foreclosures? Are you in collections for anything also? Okay, so it's really just the body of your credit when it comes to getting you pre-approved. Okay, and the best way for you to get pre-approved and learn how to basically maneuver through the market is to talk to your local mortgage loan originator. You can call me. I'm local to New Jersey. I'm also licensed in Pennsylvania and Florida. You can also call, your local mortgage loan originator if you're in other states that don't fall into, where I'm local to. What loan products are best for you also? Will you do better with an FHA versus a conventional loan? Will you do better with a USDA versus an FHA loan? It's really going to depend on what kind of property that you want to buy. All right. So once we look at the property, how much assets you have, what's your income, and then what's your credit. Those are the 4 things. So property, assets, income, liabilities. Those are the 4 things that we're going to look at when we want to get you pre-approved. All right, so stay tuned, and we can definitely see what the other steps are in this very short series. We're going to touch on all the steps that it takes for you to get to the closing table and for you to get the keys in your hand. Hope to see you in the next video.